Financial markets were relatively quiet during the summer. But behind this calm, we have seen a quite difference in terms of performance between the markets. On the one hand, bond yields did not move at all. They were completely flat. On the other hand, equity markets did rise, thanks to the US market, which had an excellent performance. European markets were relatively lower compared to the US, and emerging markets were under pressure, but we will talk again about that later. Risky assets prices are going up because fundamentals are positive and solid, and in our opinion they will continue to be solid in the future. First of all, economic growth. Global growth is there and it continues to be in line with expectations. We had good news in the US thanks to the tax reform. The decline in taxes is boosting the US economy. In Europe, we have second quarter a little weaker than expected, but nothing dramatic, and especially the employment is starting to improve substantially overall in Europe. In China, we are seeing some slowdown, but we have already the authorities taking some measures to boost the recovery later on. So overall, solid economic growth. But second aspect, which is also very positive, is the fact that inflation is not accelerating, even in the countries with full employment since several quarters. It means, and this is a third positive aspect, that the normalization of monetary policies will be very moderate in the future for the ECB, is already moderate for the Fed currently. No acceleration in inflation and moderation in the central banks. It means that bond yields will not rise dramatically. They will rise, but not dramatically. And lastly, the last fundamentally positive factor is rising earnings. Clearly, the corporate sector delivers, and we had strong earnings growth in the US, significant positive growth in European earnings. So overall, solid fundamentals. The US stock market is making new record highs, but other stock markets are suffering. They are integrating several risks, which we need to discuss. First of all, clearly the risk of tensions between the US and its partners in terms of international trade has been a break for several markets. We think, this is our core scenario, it's a more negotiation pattern from the US than a serious risk of global tensions for a long period of time. But the markets are currently taking this risk into account. Secondly, in Europe, we are facing two different risks. The first one is on Italy, second one on the Brexit. About Italy, clearly, the fiscal policy from the new government will be watched very carefully by the markets. Europe and rating agencies will pay attention to the total deficit that the government will announce. If the policy is too accommodative, it would be a negative signal for the bond markets in Italy, so watch out what happened on the spreads. The Brexit negotiations are entering the last phase of before the Brexit, before March of next year. And for the first time, markets are beginning to price a hard Brexit, meaning a Brexit without a deal between the UK and European Union. We think that the markets are too pessimistic about that. We are again on the last phase of negotiations, and we think that at the end of the day, the negotiations will prevail. Markets will of course be reactive also to this element. Lastly, emerging markets are facing pressures coming from the currency side. Several countries are under pressure because the macroeconomic balances are beginning to be less and less relevant, especially we think about the countries with a twin deficit, fiscal deficit and current balance deficit, where inflation is accelerating because of the decline of the currency, but this is a vicious circle which could put pressure again on other countries. The risk of contagion is there, and at the beginning of September we have seen the markets increasing volatility because of that contagion effect. Our investment conclusions are unchanged. We stick to the cautious view on bond markets because we expect bond yields to go up. For equity markets, we stick to the positive view. As we explained, fundamentals are solid, and because of the risk, we would not be surprised to see higher volatility. That would be an opportunity to increase positions, especially on the European and the Japanese markets. We stick to the neutral stance on the American market. No change either on our sector recommendations. We prefer the cyclical sectors and the financials, and within the cyclicals we include energy, materials, minerals. Thank you for your attention.